Okay, welcome back everyone, back to our weekly options education webinar series. Today we're going to be talking about the top 3 income strategies for utilizing weekly options. This is a webinar that's really more so as an overview of the different income strategies that you can utilize or the different option strategies you can utilize to generate income. We're going to be talking about cover calls, cash secured puts, and credit spreads. Now, this is not as in-depth as some of our other webinars on specific strategies. This is more of an overview to give you an idea of the different ways that you can generate income using options. And we're going to put it in the context of weekly options because this is really the type of options that allow you to generate the most amount of income in the shortest amount of time. And we'll discuss in a few minutes as to why that's the case. But we wanted to show you the different use cases of options depending on whether you own some stock or you want to own some stock, or maybe you just have some bullish or bearish views, how you can take all of these different scenarios and be able to generate income across all of them, as opposed to many of the separate webinars that we've done on just cover calls or just cash secured puts or credit spreads is only useful in certain times. We want to show you the whole universe so that you can look at generating income regardless of what your views are, regardless of what your portfolio looks like, and kind of giving you an idea as far as the best practices for each one of these 3 strategies. Now, I will spend about 20 minutes on the slides showing you these 3 strategies that we're talking about, what are the best practices for each one, and then we're going to go through some real examples using OptionsPlay. Now, my name is Tony Zhang. For those of you that don't know who I am the chief strategist here at OptionsPlay. I will walk you guys through here the top 3 income strategies here today. I'll talk a little bit about expiration and strike selection for each one of these 3 strategies, but more importantly, when you should utilize these 3 strategies, how to generate consistent income from each one of these 3 strategies. I think that's really what a lot of people here are here for, is to how do I utilize these strategies to consistently generate income. And a lot of that comes from automation, which will show you how to utilize our tool OptionsPlay to help automate finding these expirations and strike prices to keep you trading these consistent strategies. And then I'll touch up on exit strategies, meaning how to manage these positions once you're in them. And then lastly, we will follow this up or finish this up by showing you some real examples using OptionsPlay. Now, for those of you that have seen our webinars before, welcome. For those of you that have, welcome back rather. For those of you that are brand new to OptionsPlay, I hope that you guys have the ability to take a look at these slides that we're going to show you today, which is also going to be sent to you after we're done. There's some important links in those slides for those of you that want to watch the previously recorded webinars, such as if you want to learn more about some of these income strategies that we're going to go over here today. We have pre-recorded webinars for covered calls, for credit spreads. The webinar is recorded, and I'll send out the slides with that recording. The slides will have the links to those previously recorded webinars, as well as how to sign up for OptionsPlay if you don't already have access. So let's go ahead and get started. What are the top 3 income strategies that options traders use to essentially sell options in order to generate income? And those 3 strategies is cover calls by far dominates volumes. About 40% of all options flow is in this single strategy alone on the retail side. So, and it's really because it adds yields to your existing stocks in your portfolio, meaning you don't have to buy anything new. You don't have to have a directional view on anything. If you own any stocks, cover calls is one way for you to generate income using the existing stocks you have in your account as collateral in order to sell a naked call against that stock that you own. Now, to do so adds yield to your portfolio, and it lowers the portfolio volatility and the cost basis of the stock that you own. Now, this is the effective cost basis. This doesn't actually impact your tax lots, but it does overall effectively reduce the cost basis of the stock that you own by selling covered calls against it. Now, the second most popular strategy is selling puts. Selling puts is a strategy that you should consider for stocks that you want to own. So many of you have stocks in your portfolio. You may have certain stocks that you want to add to your portfolio or stocks that you want to buy more of. This is really one of the more underutilized strategies, in my opinion, is selling puts. on stocks that you want to own, because it's an alternative to purchasing the stock outright. It allows you to generate some income while putting in effectively what is almost like a limit order to buy your stock at a lower price, and getting paid some money to place that limit order. And then if the stock does move lower, you get to purchase that stock at a lower dollar amount, but also collect some income while doing that. And lastly, credit spreads. This is really an income trade with limited risk that allows you to collect some income based on some directional views that you have in an underlying stock. Now, credit spreads is a fairly complex strategy, so I do have a whole webinar specifically geared for that if you want to learn more about credit spread trading. So please take a look at that webinar if you're interested in some credit spreads. Now, I want to just do a quick poll before I move on. I want to get a feel for which one of these strategies you guys already trade. So there's a quick poll that I just launched on your screens. Please select all the strategies that apply. Which income strategies have you traded before? Have you traded cover calls, cash secured puts, credit spreads? And maybe some of you have traded condors and butterflies, just to get a feel for how many strategies you guys have traded before. What's actually really interesting here is looks like credit spreads is the winner here. Very interesting. I will give it one more second. So please, please type or please answer the poll. Looks like we've got about, most of you have voted by now. So a clear winner here actually is credit spreads, which is a little different than what we're seeing in terms of actual volume from retail traders, but that's really good. That means a lot of you are utilizing credit spreads in your trading. So for those of you that do trade credit spreads, please take a look at that video that we've done specifically on credit spreads. We go really in depth into best practices for trading that strategy. Number 2 is covered calls. At 65% of you have traded covered calls before. Only 48% of you have sold cash secured puts. That's interesting because if for those of you that sell covered calls, you should be looking at cash secured puts as well, especially if you're trying to generate yield off of the stocks that you own or stocks that you want to own. Cash secured puts is a great way to consider doing that. And I really think it's an underutilized strategy by a lot of users that sell covered calls, because you have the exact same risk profile as covered calls, and it really allows you to dollar cost average into the stocks that you want to own instead of just outright buying it at the current price. So for stocks that have high volatility, for stocks that have some downside risks, cash secured puts is a better way to potentially dollar cost average into your stock and generate some income while doing so. 40% of you have traded condors and butterflies, which is great. And I expected that to be the least amount, but actually 40% was a little higher than I thought it would be. But one thing that I want to point out is condors and butterflies is really just a combination of credit spreads, or if you combine the put and call credit spread, that's how you get your butterflies and condors. So, I'm not surprised that because 73% of you have traded credit spreads, that a lot of you have also traded butterflies and condors. And for the 17% of you that have never traded any of these strategies, well, I hope that this webinar really helps you understand what are the different possibilities for generating income and how you should, or what scenarios you should use each one of these strategies. Because regardless of whether you own stock, whether you want to own some stock, or maybe you have a bullish or bearish view on a stock, these are the 3 strategies that you can deploy options for to generate some income in your portfolio. So let's go through each one. But first, I want to talk about why we think you should use weekly options for using any of these 3 strategies. So here's a time curve, time value of premium. And as you can see, this is a curve that decays in time as you get closer and closer to expiration. And the thing you'll notice here is that curve decays faster and faster as you get closer to expiration, at the point where right before expiration, that curve is basically a straight line down, meaning you are losing money at an infinite amount pace, if you will. So as you can see on the weekly options, that pace at which the time value erodes is much, much faster in that last month than the previous 3 months. As you can see, you actually lose roughly the same amount of premium from month 4 to month 1 as you do from month 1 to month 0. So the time value of an option decays about the same amount in the last month than it does in the previous 3 months. That's why we generally want to sell weekly options, because we want that to decay as fast as possible so that we can make our profits in the shortest amount of time. If we can make the same amount of money in 1 month versus 3 months, why would we ever sell a 4-month option? That's really why we want to focus our attentions when we're selling these types of strategies, cover calls, cash secured puts, and credit spreads in those weekly options, because it really allows you to take advantage of that theta decay that gives you profit very quickly. So that's really why we want to focus our attention here on weekly options. Now, I want to talk a little bit about the trading strategy of each one. Again, this is more of an overview. This is not going in depth. If you're looking for that in-depth explanation, I highly recommend you to take a look at some of those previously recorded webinars. So for cover calls, this is really when you have a bearish to neutral market view on the underlying stock that you own, and you want to generate some income because you have a bearish or neutral view on that underlying stock. You can sell call strikes above the current price. So if, let's say, you have a stock trading at $100, you have a bearish or neutral view on that stock, but you own it and you want to generate some income, you want to sell a call strike that's above the current price. So maybe a 105 strike, 107 strike. OptionsPlay actually helps you determine which strikes to sell. We'll cover that when we get to the OptionsPlay tool. Short puts is for those of you that have a bullish or neutral view on an underlying stock. So if you want to own a stock and you have either a bullish or neutral view on that stock currently, you want to sell put strikes below the current price. So if you have a $100 stock and you think it's going to stay where it is or maybe move a little higher, you can sell maybe a 95 put or a 92 put, something below the current price. And for credit spreads, this is really for those of you that have either a bullish, bearish, or a neutral view, because you can trade bullish credit spreads and you can trade bearish credit spreads. So you have the opportunity to do both. And there are also credit spreads that are useful if you are simply just neutral, meaning you don't think the stocks are going to go anywhere. So credit spreads are actually quite versatile in terms of when you can use them. But the rule of thumb here is to sell an out-of-the-money strike, whether you do a call or a put, depending on whether you're bullish or bearish. You always want to sell an out-of-the-money strike, and then you want to buy a strike that's further out of the money. That's how you create your credit spread. So that's just a quick overview of these 3 strategies, when you should utilize them, and what types of strike prices you should be using to generate income. Now, we'll go through some real examples so that we make it more tangible for you. I know selling above and below the current price, sometimes it's not tangible. So we're going to go through some real examples with some real stocks, and then we'll show you looking at income strategies on those stocks. So now that we talked about these 3 strategies, why we should focus our attention on the weekly options specifically for generating income, and what type of strikes you should be looking for, what type of expirations. What I want to talk about is how to generate consistent income from these strategies. So, we've talked about selling covered calls, and I think that's a good example here. If you're selling covered calls, how do you make sure that the monthly covered calls that you sell, you gain some consistency for that? And the answer is actually quite simple. You generally want to choose an expiration date and strike price based on your personalized preferences. And I'm going to go over that in the next slide as to what those personal preferences are. But really, in order to generate consistent income, all you have to do is follow the same methodical approach every single cycle. What I mean by that is that if you decide that you're going to sell weekly options and you're going to sell options that are fairly conservative, then you want to make sure you sell the same expiration and same strike prices month after month, quarter after quarter. If you use that same method every single month, you're going to be able to gain consistency in your portfolio, especially if you use deltas to help you choose your strike prices, because delta already accounts for different variances in volatility, variances in the fact that maybe earnings is coming up or some kind of catalyst is about to come up, so volatility is a little higher. So delta already adjusts for that change in expected volatility in the future. So, and one of the best ways to gain that consistency or keep a methodical approach cycle after cycle is through automation, because automation really will help take the emotion out of trading. It will help take the selection process of figuring out which expiration date and strike price out of manual work and automating it so that you tend to stay consistent. That's really what we want to show you here today, is how OptionsPlay can help you find that methodical approach and help automate that approach so that you're not going through finding an expiration and strike price manually every single time, because if you do it manually, chances are you may deviate a little bit away from your methodical approach. We've all been prone to this when we're looking at that option chain, especially if we're generating income. We tend to gravitate towards the prices and the strike prices that give us a little bit more income. And sometimes that deviates away from the approach that we should be taking. And that's really why we want to show you OptionsPlay. By taking that out of the manual approach, we really help you gain some consistency. So what I want to explore is different expiration selections. So even though I've mentioned that weekly options is where we believe you should focus your attention on, in reality, which expirations you choose should be based on your personal preferences and how frequently you trade. So I want to go over the different expiration dates, what it means, what you should expect if you choose different expiration dates. So I have three categories up here. First, I have active traders. This is for those of you that fall under the category like myself. You have time to look at your account pretty much every single day, maybe once every 2 days. You're trading mostly shorter dated strategies, or strategies that have relatively quick turnaround, and you have the opportunity to keep on top of your account almost on a daily level. For these types of traders, you want to focus your attentions on the shorter end of the spectrum. So these are the weekly options we're talking about. Usually you want to go out about 3 weeks out is usually where you're going to be able to find enough premium to sell. You know, a lot of times the 1 or 2 week options just don't have enough premium. So usually you want to go anywhere from 3 to 7 weeks out. That's the sweet spot that you're going to be able to generate some consistent income while still selling shorter dated options. For those of you that are longer term buy and hold investors, so if you buy a stock and you hang on to it for months, or if possibly even years, and you don't look at your account very often, maybe once a month or once a quarter, you would fall under the buy and hold category. Buy and hold category. And for those of you that fall into that category, you want to sell longer dated options. And this is simply a function of how frequently you have to look at your accounts. You know, we don't recommend you to sell weekly options or 3 week options if you're only looking at your account once a month or once a quarter. You want to sell longer dated options like 3 to 6 months out. And then many of you may fall somewhere in between. You might be casual investors that look at your account once a week or once every couple of weeks. You want to sell medium-term options, so anywhere from 50 to 89 days out. So this is about 1 to 3 months out, or 1.5 to 3 months out. So you really want to choose an expiration date that suits your trading frequency. So for those of you that are in the chat window, just please type, active, casual, or buy and hold investor, just so I know kind of the breakdown of the users here that are attending this webinar. You know, if you trade actively, type in active into the chat window. If you're buy and hold, please type that buy and hold, just so I get a feel for, the audience here in the room. Looks like by far most of you say that you are active, which is great. A couple of casual or medium terms. I don't see any buy and hold investors. Okay, so it looks like every one of you is on the shorter end of the spectrum, which is great, right? So the reason I wanted to highlight this is because when you're talking about short dated options, you have a lot more certainty as to what's going to happen between now and expiration. Because if you're selling a 3 week option or a 4 week option, things like earnings, dividends, news announcements, product launches, things like that, we generally have a fair amount of visibility in the next 3 to 4 weeks. It's certainly not going to creep up on us and, all of a sudden a news announcement is going to, or a corporate action is going to be announced 2 days ahead of time. That generally doesn't happen. So because we have more certainties what's going to happen between now and expiration, you generally will have less income for that short dated option that you sell. But like I said, what we really want is not necessarily just more income. We want the income as fast as possible. And that's really why the weekly options are more suitable. For those of you that are on the long end of the spectrum, which doesn't sound like anyone here is, but when you're selling a 6-month option, you have a lot less certainty as to what's actually going to happen. So this is really why you're going to receive more income if you're selling a 3 to 6 month option. Next, I want to talk about strike selection. So when you're selling premium for covered calls, cash secured puts, and even credit spreads, it depends on how aggressive you are, how conservative you are with respect to risk taking. So when you're conservative and you don't want to take a lot of risk and you're okay with taking a lesser premium, you want to fall under the conservative end of the spectrum. So this is really where you're looking at strikes that are around 10 delta. And 10 delta means that this strike has about a 90% chance that call or put will expire worthless, and you will keep the premium that you receive. So if this is relatively conservative, you have a very high probability of success, but that also means less income. Conversely, on the other end of the spectrum, for those of you that are aggressive, that want to take on risks, and you're okay with taking on more risk because it's going to receive more income for you, you want to choose deltas that are somewhere around a 30 delta. This gives you about a 70% probability of success on each trade, or 70% chance that call or put that you sold will expire worthless. And then for those of you that are somewhere in between, so I myself fall under the optimum track, this is really where you want to shoot for roughly about a 20 delta call or put. And this will give you calls and puts that have roughly an 80% chance of that call or put expiring worthless. So once again, please type into the chat window which one you fall under, conservative, optimal, or aggressive, just so I get a feel for, again, the audience here in the room. So type in conservative if you really don't like to take on a lot of risk and you're okay with taking lesser premium, and then aggressive if you really like to take on that risk. Because when you're selling conservative strikes, this is really strikes that are very far away from the current price. That's going to result in less income because you have a far less probability of expiring worthless. And then when you're selling aggressive strikes, these are closer strikes to the current price. You're going to get more income for those. So it looks like there's a pretty good straddle here of mostly optimal, but there's quite a few aggressive risk takers here in this group, but also at the same time quite a few conservative answers here. So it looks like we've got a pretty diverse group here in terms of risk tolerance, okay? I think there was a question here about what's POW. POW is probability of expiring worthless. So when you sell a call or a put, you want that call or put to expire worthless because that means you get to keep all the income. So probability of expiring worthless tells you the chances of that call or put expiring worthless. And delta is usually just the inverse of that. Or delta is a proxy for probability, and it's the inverse of telling you what is the probability of that call or put being in the money. So what we're really looking for is that call or put expiring out of the money. So that's the inverse of delta. So what are some of the optimal strikes? So, and what we're telling you here is that you should choose your strikes based on your personal preferences or your risk tolerance, but we also back tested all of these strategies to see where do you actually get the highest returns from these strategies. So number one of the biggest things that we found during our back testing is to always avoid earning cycles. Meaning if you're selling weekly options, you're selling maybe every 3-4 weeks out, you generally don't want to do this when there's earnings coming up because these are huge catalysts in the underlying stock that can cause either the stock to go in your favor or against you. And you generally don't want to sell cover calls going into earnings. So this is, or I'm sorry, any of these strategies going into earnings. So this is really one of the number one things that we found through our back testing. So when it comes to cover calls, we've generally found that it's way better to sell more conservative strikes. So about a 15 to 20 delta call is usually optimal for cover calls. And the reason for this really is because you want to give your stock upside to appreciate. Because when you sell a cover call, you're doing it on stocks that you own. You own that stock because you're expecting it to appreciate in value in the future. If you're selling a very aggressive cover call, you're not giving that stock the opportunity to grow. And if you do that, you're going to limit your capital appreciated on that stock. And what we found is that when you select very aggressive strikes, you certainly are getting more income. But what we found is that that income doesn't offset the losses or the lost opportunity, if you will, of the stock continuing to move higher. So that's why when we're selling cover calls, you generally want to gear more so on the conservative end of the spectrum, about a 15 to 20 delta call, giving your stock some room to upside to grow so that it can appreciate in value. When we're shorting puts, this is really where we find it's better to be on the more aggressive side. 25 to 30 delta is usually about the the optimal place to sell puts. And then when it comes to credit spreads, this is where it gets a little complex, and it's hard to just sum up one specific way to sell credit spreads, but we've backtested all different types of combinations of selling credit spreads. And the one thing that really kind of brings us into, we certainly tested a bunch of deltas, but the one rule of thumb that we think works pretty well in selling credit spreads is you want to collect roughly a third of the width. And when we say the width, that's the distance between the two strikes. So whenever you decide what the width is, moving those strike prices until you're collecting roughly a third of the width, that usually is what we consider the optimal credit spread, or at least a credit spread that you should be looking at to start off with. And then you could make minor adjustments to that, but you generally want to start where you're collecting roughly a third of the width of the distance of the strikes. And I'll go through some examples of this. I don't expect you to just take this and be able to implement this. I'll show you some real examples of some stocks that we're going to take a look at, and we're going to look at some cover calls, short puts, and credit spreads. So lastly, I want to talk about exit strategies, how to manage these positions. So based on all of our back testing, almost every single rule that we tested for rolling a strategy early, almost none of them did anything. So we really found that it's best to really let these types of income trades sit, meaning let them do their work, let the time decay, let you collect that income is usually the optimal strategy. Almost every single type of exit strategy that we tested did not yield in better results than just leaving that trade alone. So we generally found that it's only best to roll your position within the last week. So when there's almost no more theta left to be made and you've made most of your profits or most of your time decay, that's when it's time to roll your positions, whether it's a cover call, a short put, or a credit spread. And what I mean by roll is to simply close your existing position and enter a new one. So if you've sold a cover call that expires in November and it's now November expiration, you want to buy back that November expiration and then sell a December expiration. And then by December, you want to roll that to a January, and a January to a February, and so on and so on. So you only want to roll your position when it's about a week left from expiration. The only time that we think it makes sense to take profits early or close out one of these trades early is if you've made about a 75% gain on the trade, but you still have more than 2 weeks left. So if you made most of your premium or most of your profits that you can make on a trade, and there's still more than 2 weeks left, that's when you can roll early, meaning buy back that call and sell another call or put or credit spread if you've made that money with plenty of time left to go. So some tips on selling cover calls. One of the things that I've heard a lot from users that have told me that they don't like to sell cover calls because they don't want to generate a huge tax bill on the stocks they own, which is a very legitimate concern that, you might own Apple stock from, I don't know, $25 because you bought it 15 years ago or 20 years ago, and you're afraid that if you sold your stock at $220, you're going to have to pay a huge tax bill. What I tell users is that just because you get assigned on a call on a stock, it does not mean that you have to deliver that lot of tax that lot for tax purposes. Meaning you can actually buy more stock on Monday morning and deliver that. So if, let's say, you got your Apple stock called away at $220 and you don't want to pay a $200 per share tax bill on that stock, then what you can do is you can buy more stock on Monday morning and actually deliver those shares so that you're not realizing a gain from the $20 shares that you own on Apple. So that's a key thing to remember, that if that's one of the reasons that's you're concerned about selling covered calls is because of the tax bill, make sure that you understand that you can actually buy more shares on Monday and deliver that tax lot as opposed to the $20 tax lot. Second of all, when you're shorting puts, make sure you maintain enough cash to purchase your shares. Because if you end up on Friday night where the stock is below your strike price and you forgot to close it or you didn't close it, you need to have enough money in your account to buy 100 shares of that stock for every put contract that you have. And if you don't, you're going to get a margin call on Monday. So making sure that you maintain enough cash to purchase your shares. And if you don't, make sure you roll your positions to the next month. So those are some of the tips on selling covered calls and cash secured puts. I have a lot more tips on selling credit spreads, but I do think that for that, you should look at the credit spread webinar that we've done. I'm not going to get into all the intricate things about selling credit spreads. Many of you already trade credit spreads, so chances are you've probably watched my other webinar on credit spreads, but if you haven't, please make sure you go ahead and watch that. I go into a lot more things on the credit spread side. So what I want to do now is I want to bring up OptionsPlay. For those of you that have never used this platform before, you can sign up for a free trial at optionsplay.com. What I wanted to go over first is I want to show how you can easily use our platform to quickly find cover calls and cash secure put ideas. Then what we'll do is we'll come back to using OptionsPlay for credit spreads. So first of all, what I'll do is actually I will ask the audience for some symbols to look at. So throw out some symbols of some stocks that you own in your account or some stocks that you want to own in your account. Let's try to keep them to kind of larger cap names where we know the stock. Okay, so let's look at Amgen. So Amgen's trading at 208.89. Oh, I got a lot of symbols here. Okay, thanks guys. I think I have more than enough symbols to look at. So Amgen. So for those of you that have never seen our platform before, it's divided into 3 sections. We have trade ideas and watch lists here on the left-hand side. Our security analysis panel here is in the middle, and then we have trading and income here on the right. So the 3 panels is designed to tell you what to look at, meaning trade ideas and watch lists is what symbols do you want to focus your attention on here today. The security panel here is designed to tell you why you should focus your attention on that, meaning what are the trends of the stock, how is it performing relative to the current market, things like dividend, price action and earnings data, and then lastly, trading and income, meaning how can you take advantage of this stock. So today what we're going to do is we're going to first focus on the income tab, which will tell us which cover call and cash secured put to trade, and then I'll come back to the trading tab to show you the credit spread side. And I want to show you how easy it is to pull up a cover call and cash secured put using our tool compared to pulling up a full options chain. So before you utilize the income tab, when you click on the income tab, there's a button at the bottom that says income settings. And it's really important that you set these settings first. And all you have to do is once, but it's really important that you do that first. So we talked about selecting a time frame that matches our personal preferences. So most of you said you were active, so you would select a short-term time frame. Now, most of you said you were optimal, but a few conservative and a few aggressive ones. So make sure you select the appropriate one, and you can set covered calls and short puts independently of each other. So for example, for cover calls, I like to choose optimal. For puts, I like to choose aggressive. And this also follows, some of the back testing we've done that shows that cover calls, we want to lean a bit more on the conservative end of the spectrum, and for puts, we want to lean a little bit more on the aggressive side of the spectrum. So these are my settings. Make sure you create your settings based on your personal preferences, and all you have to do is save this as default. Once you do that, OptionsPlay, when you click on the income tab, will find you the cover call and cash secured put based on your personalized settings. So here it'll ask me, do I own shares of Amgen? So if I'm selling cover calls and I do own shares of Amgen, I would click on yes. I would type in the number of shares I own. Let's say I own 300 shares of Amgen. Now it's telling me that I can look at selling the October 19th 217.5 cover calls. So these are the calls that have roughly an 85% chance of this call expiring worthless. So about a 15 delta. So it's already done the work of finding the appropriate expiration and strike price, and then provides me with all the analytics that I need to decide, is this a trade I want to make? So Amgen pays a 2.5% dividend, which is a pretty nice dividend, but this cover call yields an additional 5% yield on top of that. So this is really, if I'm looking at selling cover calls, then I would consider looking at the October 19th 217.5 cover calls. This means that you don't have to pull up an option chain, figure out what the 3-week option is or 4-week option is, then try to find the 15 delta or 20 delta, then calculate yields. This all does that instantly for you. Provides you with all the analytics, and if you want to hit the trade button, it tells you how to enter this cover call into your broker's platform so that you can send this order off in the account that you own Amgen stock in. For those of you that don't own Amgen stock, or maybe you want to buy some more, and this is something that you can do a combination. We call this a covered combo. You can actually sell a cover call and a put at the same time. So as long as you're okay potentially with buying some more Amgen stock in the future, you can sell the put and the call at the same time and generate double the premium. So here, this is telling me to look at the October 19th 205.5 cover calls. So this, I'm sorry, the 205 puts, telling me that I can generate 14% annualized return on this particular trade, and I will own stock at 205 if the stock goes below 205 on October 19th. So this allows me to very quickly type in a symbol and immediately tell me which cover call I want to look at if I own the stock, and which put I want to look at if I want to sell, if I want to potentially own some more of this stock. And keep in mind, you can do both at the same time. You don't have to just do one or the other. It's called the cover combo. It's not a strategy that I've talked about very much in the past, but I may bring up a separate webinar just on that alone, because it is actually a very popular way to generate some additional yield on your portfolio. Next symbol I have here is Berkshire B. Berkshire Hathaway 216. So let's say you own this stock and you want to sell some cover calls. On the cover call side, this is telling me look at the October 19th 222.5 cover calls. This yields a 6.5% yield on the stock. And if you own Berkshire B, you get paid $0 in dividends. So this is not something, if you own this stock, you're not getting paid any dividends. You should consider using a cover call to generate some yield on that stock. Conversely, if you want to own this stock, you should look at October 19th 212.5 puts. That gets you a 10% yield. So this is really all the information that you need to look at a starting point for selling covered calls and cash secured puts. And notice how quick it is. I can type in any symbol and within a few seconds know exactly which cover call and short put to look at. See, I have a request here for RUT, but RUT is a index option and you can't own that index option. So you can't really sell cover calls. You can sell some naked puts, but I also don't recommend doing that. So I'm going to skip that for now. We could come back to that for credit spreads. CGC, Canopy Growth. A lot of you are interested in some of these weed stocks doing very well, certainly all over CNBC. So if you own the stock, selling a cover call here, October 19th, 62 cover call, very far, $12 out of the money. Notice this has a 36% yield. That's a very nice yield on a stock that pays you no dividends. So with such high flying stocks with such high volatilities, you do tend to see sometimes some of these pretty crazy numbers here. Selling puts, the 45 put will generate 75% annualized yield. Now I'd say you probably have a pretty good chance of this put getting put to you, but as long as you understand the risks, here as you can see very quickly, you can type in any stock and immediately start to see what are your possibilities for covered calls and cash secured puts. And I really want to, show you guys, if you're pulling up an option chain, let's see if you're pulling up a full option chain, I'm trying to see if I can find one that's easy to use. Here we go. So what I want to do is help compare, looking at options using OptionsPlay versus using an option chain. Because if you're pulling up an option chain in IBM, you're going to spend quite a bit of time scrolling through the different expirations and different strike prices and manually looking for these things, versus this just brings it to you at the tip of your fingertips. So here I type in IBM and immediately tells me to look at the October 19th 160 covered calls. And if you're selling puts, the October 19th 147 puts. So it tells me exactly what expiration, what strike price, tells me all the annualized returns, so I can quickly decide, is this something that I want to place? Is this a cover call or a short put that I want to place in my portfolio? Giving me all that information. If I do, I hit the trade button and it tells me exactly how to enter this order into my broker's platform. So we are completely broker agnostic, so that you can use this for any broker that you trade with. I'll go through one more example just to kind of go through it. I've gotten a lot of requests here. CVX, Chevron. If you own this stock trading at 122 right now, this is telling you to sell covered calls looking at the October 19th 127, generates a 5.5% yield on a stock that pays a pretty nice 3.6% dividend. So this is actually a stock that if you own, you're already getting a nice yield, but you can add to that yield another 5.5%, which brings your total yield to 9.2% from 3.6. So a significant bump in yield by adding cover calls to a stock that you already own. And, in my opinion, the way I think about cover calls is really taking the assets that you already own and extracting more yield out of it. Meaning you own these assets, you might as well utilize these assets to try to generate some additional yield. And if you want to own Chevron, looking at the October 19th 120 puts, or if you want to own more of Chevron, selling the October 19th 120 puts, 12.8% annualized return. So very high amounts of yield by selling these short puts. And again, if you look at the risk profile chart of a short put, it looks exactly the same as the risk profile chart of a covered call. It's there for a reason. And this is really why I think the puts is an underutilized strategy, because for those of you that sell covered calls, you're already taking basically the exact same risk profile as a short put. You just may not think of it that way, but the risk profile is exactly the same. So if you sell a covered call, there's no reason that you wouldn't consider taking a look at a short put. And it's a great way to add additional yield, because puts do trade at a higher implied volatility, which means that you get higher premiums. And as long as you don't mind owning more shares of that stock, it is one way to consider doing that. So with that, what I want to do is I want to jump back over to the credit spread side. So let's say you have a bullish or bearish view on a stock and you think it's going to go in one direction or another. How do you take advantage of that view? So I don't have a specific symbols per se in mind here. I'll maybe take a look at some of the symbols that were suggested here. Let's see, maybe IBM. Let's take a look at IBM. So IBM recently broke above this 150 resistance level, came back down, broke, kind of gapped up higher. Maybe we think IBM is going to continue going higher. Now, I'm not saying that you should trade credit spreads in this particular environment, but let's take a look at it. Let's take a look at what I'm going to do is I'm going to modify this trade. Instead of buying a call, I'm going to use our strategy constructor. I'm bullish, so I'm going to do a short put vertical. This is the bullish vertical on this particular trade. I'm going to change the expiration dates to a shorter dated expiration. So we talk about using weekly options. So let's take a look at the October 19th. And let's change this to a $5 width. So we talked about if we're selling credit spreads, we want to collect roughly a third of the width. So here's a $5 width on IBM. So what I want to do is I want to find a spread that will give me roughly a $1.60, if you will. Now, oh, this doesn't really work very well because there's, let's see, 149, 144. That will collect me $1.28. So let's say I look at the 145, 150. So $5 width, I'm collecting $1.47. Let's say, what if I collected on the mid? It's $1.51. So very close spread. And this is pretty close enough to that 161 that I'm looking for. As you can see, above the 150s, there's no dollar strikes anymore, which makes it a little bit more difficult to find an exact one. Probably the ideal strikes are 146, 151, but unfortunately the 151s are not available. So let's take a look at this one. This is how you can utilize our OptionsPlay tool to look at a vertical, a credit spread, analyze it using the P&L simulator so that if IBM stays where it is around 151, how much profit you should expect. If it continues going higher, what is your expected profits? Unfortunately, with credit spreads, your reward is limited to the credit that you receive. So even if IBM goes up to 200, you're not going to receive any more credits. That's really one of the downsides to trading credit spreads, is that, you know, if you call the direction correctly, you don't really get rewarded for calling that correctly. And that's really why debit spreads is more a better strategy to take that directional view. Credit spreads are really for those of you that have a relatively loose directional view. You don't have a strong directional view, but you're pretty sure IBM's not going to go below a certain level or above a certain level. That's when you want to utilize credit spreads. And then also conversely, what if you're wrong in this trade? What happens if the stock plummets? You know, what is your loss? Well, how much do you lose here on this particular trade? That's really how you should utilize this tool to help you find a credit spread very quickly. And then let's take a look at the same time. Let's just, for argument's sake, for some users, maybe you're bearish on IBM. So let's take a look at a short call vertical. So let's look at that October, same thing, October 19th, but instead of selling the, let's take a look at a $5 width. So here, if I sold the 152, 157 and a half, $5 width, I'm going to collect 175. So a little more than a third of the width. So I'm actually getting more collection here on the call vertical than I am on the put vertical. So here, as you can see, here I'm going to collect roughly a third of the width. And if this IBM stock stays exactly where it is, I collect that 175. If it goes a little higher, I lose 325. If it goes a little lower, I collect 175. So this really allows you to take a look at all the scenarios of where IBM can go, what your expected gains, what your expected losses are. And for those of you, the 40% of you that said that you've traded iron condors, an iron condor is really the combination of both these strategies combined. So you're basically selling that put credit spread and that call credit spread in a single strategy, and that's how you get an iron condor, or potentially an iron butterfly if the two middle strikes are exactly the same. Now, the reason that I generally don't discuss trading iron condors and butterflies is because, as you can see, one is a bullish strategy and one is a bearish strategy. So it generally doesn't make sense to trade a bullish strategy and bearish strategy at the exact same time, because you can't really be bullish and bearish on a stock at the exact same time, nor are there any indicators that I know of that tell you that a stock is both bullish and bearish at the exact same time. Usually it's one or the other. Now, you could argue that if an indicator is neutral, that's when you want to enter it. However, I also don't know any indicators that tell me a stock is going to stay exactly where it is and it's not going to move any higher or move any lower. It simply doesn't exist. So that's why, I'm an advocate of trading condors, but I believe that if you're going to trade condors or butterflies, you should trade these two separately. Meaning, if for right now you feel that IBM's a little overbought, then sell the call credit spread. And then if the stock drops a little in the next few days, you can then enter a put credit spread because you think the stock's going to move a little higher. So you want to like in and out of these butterflies and condors by getting into a call vertical first, and then maybe get into a put vertical a few days later when you feel that the markets are a little oversold. So you really want to combine these two into an iron condor. You generally don't want to trade these two as a single strategy. So that's my take on using butterflies and condors, is break them up into the credit spreads, and you can use our tool to actually look at the put side and the call side separately, see how they perform in different environments that you expect it to, look at the break-even prices to see where did they break even, so that you have a better understanding of when to enter that put credit spread side and when to enter that call credit spread side. But this is really designed to make this process as easy as possible for you so that you can type in any symbol and within a few seconds see strategies on taking advantage of a bullish or bearish view, either through credit spreads or on the income tab for those of you that are looking to sell cover calls, which strikes to choose, and for puts, which strikes to choose instantly, so that you don't have to spend hours and hours looking through option chains to find those expirations and strike prices. So with that, that's what I wanted to show you guys here today. I want to thank everyone for taking the time out this afternoon, contributing the signals, the symbols that you've asked me to take a look at, as well as taking a look at, sharing with me, how actively you trade, what your risk tolerance is. So for that, what I want to do is I want to open this up for Q&A. Looks like I have a few questions already queued up. I'm going to answer as many questions as I have time for. Like I said, this webinar is recorded. So for those of you that want to take a look at the slides or the recording, you'll be able to get that after we're done here. I send them out roughly about 30 minutes after the webinar is over. So let's see. Is it a good idea to leave it worthless? Rose, I'm not exactly sure what you mean by that. If you're referring to whether you should close out, if an option is worthless, just leave it worthless. It'll expire worthless, and you keep all the premium. Certainly, you don't need to close out a trade that's worthless. David is saying cover calls are ideal for Roth IRA accounts. You don't have to worry about tax consequences. So yes, absolutely. So the one thing that I will say about retirement accounts, though, is that if you have a cover call that you want to buy back on and you don't have enough cash to cover that, that might be a problem. So that's the only caveat about trading some of these in a retirement account, is because there are limitations as to how much cash you can put in or deposit into that account. So sometimes if you don't have enough cash to cover a position, you may run into some trouble. So keep that in mind. October 19th is a monthly. So that's a good point. So I think James is asking, October 19th is a monthly, not a weekly. So when we talk about weekly options, it doesn't actually matter whether it's a weekly or monthly option. Weekly options just refer to anything that expires less than 7 weeks from now. So it could be a monthly expiration. It doesn't actually have to be a weekly option per se. Just anything that expires 7 weeks or shorter is what we consider a weekly option, because there's no actual difference between a weekly option and a monthly option from a trading perspective. It's just the expiration dates are different. They're just giving us more flexibility. So yes, you can trade the monthly options as long as they're less than 7 weeks out. I am able to use different studies such as pivot points or MACD with the platform, or am I able to use different studies such as pivot points or MACD with this platform? So yes, you can use MACD, but we don't have pivot points, but you can enter studies here and you can add your MACD right here on the screen. You can click on the expand button, which is right here in the upper right-hand corner. And under the studies button, you can add your popular indicators. James is asking, or does weekly equal any week less than 40 days? Exactly. So anything less than 49 days, which is 7 weeks out, that is what we consider weekly. 1/3 of the width equals 33% ROI. Yes, exactly. So if you consider the margin requirement as the cost of the trade, and you're collecting 1/3 of the width, then you can think of the ROI as either 33 or 50%, depending on what your margin requirement is. If your margin requirement is the total max risk, then it's actually a 50% ROI. If your margin requirement is the full width, then yes, it's 33%. Thank you to Amar and Michael. I appreciate it. How long is the trial? The trial is good for 30 days. If you don't have a trial, you can sign up at OptionsPlay.com. Adina is saying, interesting. Your comment on the cover call and the short put have the exact same risk profile. What are your thoughts on Revenue Canada prohibiting cash secured puts in registered accounts, citing limitless risk? So if you think about limitless risk, well, technically your stock position has the same limitless risk, or unlimited risk rather. So when you buy a stock, that stock can go to zero. That's the same amount of risk that you're taking when you're shorting a put. So I find it really difficult, and I think this is really more of a lack of understanding of put options and options more so than anything else, because when we're shorting a put, we're saying that this is an alternative to buying the stock. So when we think about comparing buying the stock to shorting a put, you actually have less risk when you're shorting a put than you do about outright buying the stock. Because if I bought Harley Davidson right now at $45, my risk is all $45 a share. If I sold this 44 put, my risk is actually 44 minus 47 cents. So my risk is actually $43.53. So I actually have about $1.50 less risk of selling the 44 puts than I do of buying Harley Davidson at $45. So I really genuinely believe that short puts is a strategy that a lot of people avoid because they hear that it has unlimited risk and they kind of get scared by it. But in reality, it's actually less risk than the stock that you buy. So that's why I really believe that this is a strategy that if you buy stocks and you sell cover calls, you should be looking at cash secured puts that generate some additional yield for your portfolio, especially on the stocks that you don't mind owning more of or the stocks that you want to buy more of. Michael saying, please explain what you mean by full width or 1/3 of the width. So this is referring to the credit spreads. The credit spreads, whenever you sell a credit spread, the distance between the two strikes. So for example, here, if I'm going to sell a 47.5, let's do this. If I'm going to sell a 44.5, 41.5, that's a $3 width. So the full width is $3 here. I'm collecting 76 cents out of that $3, which means that my max risk is the remaining amount in that width. So you can always think of your width as your total opportunity. What you're collecting is your max reward, and the rest of it is your max risk. So the max risk is usually typically your margin requirement. So to trade this, you would have to put up $224 to trade this credit spread. Your max return on this is $76. So the ROI is basically $76 divided by 224. That will give you your maximum return on this particular trade. So that's how you calculate returns on a credit spread. Does OptionsPlay check probability of touch? So no, we do not calculate probability of touch. We only calculate probability of success at expiration. Are there criteria for choosing a stock for cover call? The only criteria you have for choosing a stock for cover call is, do you want to own the stock? You should only, and I think that's something that maybe I didn't make very clear at the very beginning of this webinar, but it's something I do certainly talk about on the cover call webinars, is that cover calls is only for the stocks that you own in your account. Don't go out and buy some stocks just so you can sell a cover call, because you're not getting much income. It's not worth buying 100 shares of Harley Davidson just to collect $24 in income. That's not why you do this strategy. This is only a strategy if you already own Harley Davidson because you think it's going to go higher, and here's a way to generate some additional yield in your portfolio while you own that stock. So please don't go out there and buy stocks just to sell covered calls. Not a good strategy, okay? Any more questions? Would you say it's better to focus in a rising market environment on selling puts rather than cover calls due to the added risk of being called? So this is really where, if you use probability to sell cover calls, you don't have to worry about whether it's a bullish market or bearish market, because you want to peg yourself to probabilities. So we want to sell calls that have roughly about a 15 to 20% chance of that stock being called away. So this is really where you don't necessarily really have to have a strong directional view. The only times that you may want to avoid cover calls, number one, is earnings. And if you really feel that there's some short-term catalyst that will propel the stock higher, over a very short period of time, then you may want to avoid selling cover calls during that time. But generally speaking, you should want to sell cover calls and cash secured puts regularly. There's not many times, in our opinion, where you don't want to be selling these cover calls or cash secured puts. Do you check options volume? Need good bid-ask spread? So we only look at the bid-ask spread. So the bid-ask spread is a much better indication of liquidity than open interest and volume. Open interest and volume just tends to pool around the round numbers. What you end up happening is that all the strikes in between the round numbers tend to have low volume and open interest, but that doesn't mean that the strikes in between are any less liquid. It just means that other people aren't trading it. Liquidity has nothing to do with what strike it is. So don't look at open interest and strike and have that turn you off from trading something. The bid-ask spread will give you an indication of liquidity. The two most important indicators, please. I'm not sure what you mean by that question. What kind of indicators are you referring to? A reason for going long versus short put is being able to margin long stock. Sorry, I'm not sure I understand that question, Amar. If you can rephrase that, I'm happy to answer that question. Can we run options backtest in OptionsPlay? So unfortunately, no. Options backtesting is quite complicated and requires us to effectively build our own options backtester. We write a lot of code to do this. We have a team of quants that actually do this work for us. So unfortunately, it's not something that anyone can just do on their own. There's a lot of different things that you have to account for when you're backtesting. So this is something that we unfortunately only do on our own. We do have a team of quants here. We're actually looking for some help. So if anyone has some programming knowledge and wants to help us out with some, backtesting some credit spreads, which is something that we're doing right now, happy to look into some collaborations with anyone that has, some experience with testing, backtesting, technical strategies and things like that. Always open to help from other people, like MacD and others. So I did a webinar recently, and I highly recommend for those of you that are interested in using indicators to gain a directional view. I've created a webinar recently on gaining your directional edge. And this is really where I talk about, I don't believe in any specific type of indicator. And I've worked with clients from just about every single trading background. And so the webinar here is Directional Edge and Explosive Option Strategies. I highly recommend you to take a look at that webinar if you're looking for indicators, because I don't believe in specific indicators. You know, I've worked with clients for a long time, and what sets good traders apart from the others is not which indicators to use, but more importantly, how consistently they use the same indicators, how consistent they are in sticking to their plans that they create for themselves. That's what sets good traders apart from everyone else. So what we provide in this webinar that I'm showing you here is a framework of how to basically simplify your research down to just a few indicators. And by using our indicators, it really forces you to apply it the same methodical way day in and day out. So please watch that webinar, and I think that will help provide some perspective on that. Where can I see IV for the strikes? Great question. You can't. We only provide IV of the whole series. So as you can see here at the very bottom, there's a volatility slider, and it will always default to the current IV. So that will show you that Harley-Davidson, the November 9th expiration, has a 30.54% IV. So we only look at the IV for the entire expiration. We don't look at IV for each individual strike. Why don't you guys suggest credit spreads in daily play? Great question. So this is actually something that we're starting to expand out to. Like I said, we're currently doing a lot of back testing on credit spreads. The reason that we don't use credit spreads for daily plays is because the daily plays are directional views, and credit spreads is simply not a good way to leverage a directional view. So if I'm bullish on Harley-Davidson, sure, I can sell a credit spread on it. But as you can see here, let me just pull up a credit spread real quick. Let's say I sell a credit spread on Harley-Davidson because I'm bullish. It doesn't make sense to do that, because if I'm right, I'm going to make a $294 profit on the debit spread versus only a $30 credit on the credit spread. So if I'm bullish on a stock, debit spreads is a much better way for me to actually profit from that. And you know, for those of you that want to learn more about debit versus credit, we have a separate webinar on understanding debit versus credit spreads, why you should use one in certain scenarios and why you should use credit spreads in other scenarios. We really break down the difference between the two and really understanding why you should use debit, when you should use debit spreads and when you should use credit spreads. And the reason we don't use credit spreads for our daily plays is because credit spreads isn't designed to take advantage of a bullish view. Like I said, it doesn't matter if Harley-Davidson stays at 45 or goes to 100, you're still going to receive the same $30 credit. And that's not what we're looking for. We're looking for actually getting paid for being right on that trade. So we're only risking $206 to try to make $294, not risking $120 to try to make $30. So the risk reward of a credit spread is completely different than what we're trying to achieve through our daily plays. What is the cost of options play, and do you think that there would be any advantages to using this system for making a decision to buy shares along, i.e. not just option strategies? Very good question. So I think if you watch the webinar on directional edge, I think you will find that a lot of people actually do use our platform just for trading stocks, because when we're looking at these large cap names, a lot of times we're able to find option strategies, but when we're looking at smaller cap names, I don't specifically have one off the top of my head, but if you're looking at a small cap name, a lot of times the options don't make sense. So a lot of times that you may have a bullish or bearish view on an underlying stock, but you find that there's no option strategies available on that. So you might end up trading the stock itself. So our directional strategies or directional views are still very useful to you as a stock trader. And sometimes just because you're bullish on a stock does not always mean that you should trade an option. We're not suggesting that options is always better for you. It's generally better for you, or I shouldn't say it, you can find option strategies that make sense on large cap names, mega cap names, even mid cap names, but a lot of the small cap names, you're not able to find good option strategies on that. So you can utilize our platform just to gain a directional view on the underlying stock, and then decide to see if there are option strategies available. If not, you might want to trade the stock instead. Oh, and just to answer your question, the cost of options play is $50 a month or $500 a year. But pop for debit spreads is usually much less than credit spreads. So great, again, great question, but I highly recommend you to take a look at understanding debit versus credit spreads, because if you just look at probability, then you're only looking at half the picture, right? Because if you're only looking at probability, then you're not looking at risk to reward. And if you look at the risk to reward on a credit spreads certainly have very high probability, but they have really poor risk to reward. So that's your trade-off here. It's not like high probabilities on itself is good. High probability sounds attractive, but in reality, high probability is traded off with poor risk to reward. So here I can find you, credit spreads that give you, many times very good risk to reward or very good probability. So here I gave you a credit spread that has 75% probability, but I'm making $23 while risking $227. So here the probability isn't very good, $35, but I'm potentially making $294 while only risking $206. So that's the trade-off between probability and risk to reward. You don't want to just focus on one or the other. If you only look at one, you're only looking at half the picture. And this is something I cover on my webinar for understanding debit versus credit spreads. Raymond, thank you so much. I really appreciate, the continued support week after week. I really enjoy having, you here on my webinars. Really, really good engagement this week. A lot of great questions. Any particular reason why you only suggest one daily play, except in some cases when you're closing some plays? As opposed, Amar, I'm not sure exactly as opposed to what. Are you saying why don't we suggest multiple daily plays? That's just, I think multiple ones may be a little too much. I think I like keeping it simple, one a day. I think is a good amount for people to research, because I don't suggest that you just simply follow my ideas blindly. You should also take the time to research the stocks, see if you agree with my analysis. And many times you might agree with my analysis, but you might disagree on certain things. Or maybe you just flat out disagree with my analysis. Let's say I'm bullish on Harley Davidson and you say, nope, I'm not. I think you're completely wrong. I'm bearish on Harley Davidson. Our platform allows you to click on I'm bearish and then take a look at some bearish strategies. So these are just ideas, and we provide you with the idea of why we're bullish and bearish on a stock. Then we'll provide you with an option strategy that will profit from that vision if it does come to fruition. But on the same token, we realize that everyone has different visions and everyone has different opinions. So you can disagree with our trade and still be able to find a trade to place. The problem with a lot of services out there that provide trading advice is that if you either follow it blindly, and if you disagree with it, chances are you just don't trade anything at all. We don't want that. We want you to be able to take our idea, and even if you disagree with the idea, to still be able to set up a trade and trade that. And that's really the power of OptionsPlay. When we give you a trade idea, so yesterday's trade idea was a T. Rowe Price. So, T. Rowe Price is a bearish stock in a bearish sector. So that's why we're looking at bearish ideas. But you can say I'm bullish on T. Rowe Price instead. You're bullish on this financial sector. You think it's going to recover. So you can click on I'm bullish and take a look at some bullish strategies. That's really the goal of OptionsPlay, is to allow you to have the flexibility of not just following us blindly, but structuring your own trades if you disagree with our analysis. Adina, thank you so much. I really appreciate it. The Golden Nuggets, thank you so much. I really appreciate that. Any last questions? How many daily trades have you held at one time max? So we generally, we do our best at closing them out whenever they hit their take profits and stop losses. I would say that I don't think I've ever had more than 15 trades outstanding at any one time before we started taking profits in some way, shape, or form, or cutting losses. Thank you so much. I really appreciate it. Is it possible for your site to provide seasonality info? I've struggled with seasonality. I've tried a lot of seasonality back testing. I've tried a lot of different strategies off of that. I've generally have not found any of them to really generate much profits, and that's really why we certainly have tried a lot of seasonality stuff when we were building out this platform, but we simply did not find good results from that. If you found something different, please, please share with us. I'm happy to look at it, especially if you have some numbers to show that seasonality does provide trading ideas. We just generally haven't found seasonality to provide enough returns on the underlying stock to justify trading an option strategy on it. But if you found something different, please send them over. You can send me an email at info@optionsplay.com. I just sent that to everyone in the group in the chat window. If you have any questions on any of the stuff that we're talking about or feedback on our webinars, please send me an email. And if you have some ideas as to seasonality, technical analysis, anything related to trading that you think that we should incorporate or you think that can generate some returns and you want us to look at, please send them over. I'm happy to take a look. Steve, thank you so much. I really appreciate it. Ken, same thing. David, is relative timing of a stock progression of any value? Relative timing of a stock progression of any value. David, I'm not sure I understand that question there. If you can let me know, David, with respect to that question, just send me an email at info@optionsplay.com. I'm happy to look at that. I'm really kind of running over time here. We've got an hour and 10 minutes. So what I want to do is I want to wrap this up. I want to thank everyone for taking the time out this afternoon for all the questions. It's been great. I love answering these questions at the end. It really helps making sure that you guys understand what we're talking about, also review some of the other topics that are relevant to options trading, and really just, helps everyone better understand how to utilize our platform. So thanks to everyone for taking the time out this afternoon. I really hope you have found this useful. The webinar recording will go out around 6 p.m. Eastern, about half an hour from now with the slides. So please take a look at that, and I will see you guys next week. So next week, we're actually doing another special webinar. We're doing the hedging your portfolio using the NASDAQ 100 index options. So this is really for those of you that are perhaps concerned about a possible correction in the markets. And I think, especially with technology stocks pulling back, this is certainly something that's becoming more and more relevant. So next week, we're going to be doing another special webinar with NASDAQ on showing you how to utilize index options to hedge your portfolio, which has some additional benefits compared to just buying puts on an ETF to hedge your portfolio. So please, I hope to see you guys there next week, and have a great afternoon.